I want to spend a little bit of time talking about the balance sheet and some of the things that we look at from a lending perspective of the balance sheet, and some helpful tips that you can have as you're evaluating your balance sheet, and try to explain some of the terminology that we have as well. So when you boil it down, it's really not as complicated as it really is. So one of the first things that we look at is working capital, and really what working capital is it's your liquidity that you have in your balance sheet. It's a simple calculation. If you look on their balance sheet, you see on the top left, you see those first four rows. They come down to your current assets. That current assets of 2018 in this example balance sheet was 5.7 million. If you go directly to the right of that, you'll look at current liabilities on there, and taking a step back from that even, current assets are really anything that are deemed to be able to be converted into cash within 12 months or less. Current liabilities are anything which are due. It's a payment, it's a liability that's due within 12 months. And that's how those are separated from current to long term. So for working capital, you take your current assets of 5.7 million, you subtract out your current liabilities. In this case, it's 3,650,000. That would give you your working capital of 2,050,000. What this is literally the liquidity of the company on there, and so that's the one thing that we look at pretty closely. Other ratios that some banks use would be a current ratio, and a current ratio is literally current assets divided by current liabilities. And in this case, you want a number greater than 1. 1 means you just have enough assets, enough short-term assets to cover your short-term liabilities. In most cases, they're looking for a number of maybe 1.25 to 1.5, which means you have enough current assets to cover all your liabilities, and then having a little extra liquidity from there as well. Jumping from there, one of the things that really differentiates a co-op balance sheet from a standard, traditional business balance sheet are going to be in the non-current assets and the total net worth. So in this balance sheet example, you want to look towards the bottom. On the left side, you'll see in the bottom set of numbers, the first one is notes receivable, and underneath that is investments. Then finally is investments in co-ops. So the investments in co-ops number is the one thing that's different in co-ops than a lot of other businesses. And that's one thing. If you're talking to a bank that's not familiar with co-ops on there, they will a lot of times have difficulty trying to understand how this works. But that is, as you are a co-op, you have members' equity that you'll retain in your cooperative to help build your balance sheet. Likewise, if you do business with other cooperatives such as CoBank, you'll get patronage payments back traditionally. However, you also have equity in that cooperative as well. The equity is not liquid. That's why it's a non-current asset. That equity is paid at the discretion of the cooperative on there. So it is an asset, but it's when we start looking at the balance sheet on there and some of our ratios, and we start looking at net worth, we actually look at a local net worth. And what that local net worth does is we take out that investments in other cooperatives. And so we're looking at more of core net worth. So in this case, if you look at the net worth is 5,350,000, if we took out the investments in cooperatives of 2 million, we would be looking at a local net worth of 3,350,000. So that's something, if you're dealing with a bank that understands cooperatives, is something that we'll look at and that we'll make the adjustment on there. Another thing that differentiates the cooperative from a non-cooperative business is on the net worth side, on the right side. If you look at the second column there, the allocated earnings, or second row, typically what you're going to have in a non-cooperative business is you're going to have, you see the common stock on here, and in cooperatives you can sometimes have common stock as well. If you have a member that happens to, if you have $50 to become a member, you can show that in the common stock. In this example, they just showed that retained earnings. But typically, you'll have the common stock, and then you'll have the retained earnings on the business. With the cooperative, you'll have the allocated earnings. And what the allocated earnings are, essentially, it's the equity patronage that you have allocated to your members for previous year's profits, but you have yet to actually distribute those earnings to that member. on there. So that's a little bit different of what you'll see on a co-op balance sheet as opposed to a normal balance sheet. From a lender standpoint, that's not, at the end of the day, allocated earnings are very similar to retained earnings, and we just combine those for our calculations. One of the other things to kind of talk to, and I'll talk a little bit more about this, is we do look at leverage for a customer, and for leverage, really what that is that's looking at this net worth number compared to your long-term debt. Is the way that we look at it, and so or compared to your term debt, I'll say. So the term debt in this case is $400,000, which shows as a long-term debt on the right side, and also you have the current portion of that long-term debt. So that's the payments in that long-term debt that's due over the next 12 months. So that's $100,000. So you'd be looking at a total of $500,000 in term debt, and we would compare that to, you could compare it to your total net worth of $5,350,000 to get a full leverage, or you can compare it to your local net worth on there to get a local leverage on there. And I'll go into more detail about that in some of these future slides. One of the things I really like for this, and it's a great planning tool and kind of help you understand how crucial some of these things are, is the cash conversion cycle. What the cash conversion cycle helps you to do, it helps you to understand how much of the sales cycle that you will need to finance. So typically a lot of businesses will have a line of credit, and they say that line of credit is to finance working capital needs. And again, as we talked in the last slide, working capital truly is just liquidity. The nice thing about this cash conversion cycle is you can play with it. You can really see where those numbers come from and how, what you can do to influence how much of that borrowings that you have. So the key things for this is, if you look at the tabs, you look at your days inventory on hand. So you're looking at how many days worth of inventory do you have at your business, at the co-op. How many days of AR outstanding? So you look at your accounts receivable and how many days does it take to collect that AR, and then you look at how many days of AP are outstanding, and so how long do you have to pay your bills. So what the AP is allowing you to do, that's AP, your accounts payable, is kind of like free financing. So the best course of action as a banker, we want that AP to be as long as possible, as long as you're paying within terms. So if you're financing some short-term needs, if a company's giving you 30 days worth of trade terms, then don't pay that right away when you get the bill, unless you're getting some of a discount. Hold on to that 30 days. You're getting free financing for that. Pay that at the last possible moment. What that's doing is that's getting the free financing to offset the liquidity that you have to put in for your inventory and for the receivables, which is the money that you're being owed from some of your customers on there. So the difference between those is that comes in, and that's how much you're financing. That's how much, whether it's through a line of credit or your liquidity, your working capital on there. And for most businesses, they don't have enough working capital to support all of that, the difference in the timing needs. So that's why you have that short term, that line of credit. So I threw some examples on here. We looked at, so if your inventory, if your inventory averages 70 days before you're turning it over, and then your receivable averages 15 days before you're getting paid, so you've got 85 days worth of current assets that you're trying to somehow finance on your balance sheet. Now you have accounts payable that you're averaging 40 days to pay it. So what that's saying is, that's free financing. So now you're down to 45 days worth of this short-term inventory receivables that you're needing to finance. Let's look and see. Okay, if you have if your sales are $1,820,000, you take that by 365. So now you're looking at sales of $5,000 per day. Well, I just told you you're trying to finance. You've got essentially 45 days worth of sales that you have that timing difference on. So for this calculation, then you would look at that 45 days times the 5,000. So you're looking at $225,000 worth of money that's basically tied up in inventory and accounts receivable And if you don't have $25,000 in cash or $225,000 in cash, then that's where you look at the line of credit. Now, again, what are ways to be able to reduce that line of credit, reduce the borrowing, and essentially reduce the interest that you'll pay? Look at the maybe you can have tighter inventory control. So maybe you reduce that inventory from 70 days to 65 days. Maybe you're hopefully you're taking advantage of the terms for your accounts payable, but if you're not, that's a way to help reduce that. But for each of these categories, 1 day improvement equals $5,000 worth of average loan improvement on there. So it's $5,000 on average throughout the year that you're not paying interest on, and so that can really add up. Next, going into liquidity, liquidity really, for any bank or for anybody, liquidity is the most important thing of any balance sheet. You can have a profitable business that can go bankrupt just because they just don't have the liquidity to be able to support the business on there. So, as I put in here, liquidity truly is the lifeblood of every business on there, and that's probably the first thing that you need to look at when you're starting up a cooperative. Additionally with that liquidity is looking at your accounts receivable, because accounts receivable are part of, when we look at working capital, that's part of that that current assets, part of the liquidity balance on there. But beware, as you have these, if you have concentrations in just a few customers on there, that puts a lot of, we call it counterparty risk. That puts a lot of risk on you, because now you're dependent on this one individual, this one other business to receive payment. If that represents a large amount, 30, 40, 50%, or even more than that of your receivables, and all of a sudden they go bankrupt, they're unable to pay you, even if they're paying you late, that could cause liquidity issues on your business as well. So we always, you want to be diversified as much as you can with your customer base. If you do have a concentration, you need to, pay very close attention to them, to the point where you might even ask for financial statements from that customer, just to make sure you feel comfortable with them. And that goes to, the third point there, as I talked about, you can have, I've had multiple customers that were, had been profitable customers that had a large account receivable that they had to write off, and then they were never able to recover from it, and eventually had to close down the business. And the other thing is utilize long-term loans and leases to conserve your liquidity. So that's another trap that some of my customers have gotten into. As a matter of fact, I've got a large customer that I've lent to that I just met with yesterday, very large, very sophisticated, and they were having issues with running out of money on the line of credit. Well, they had financed over the last couple of years. I think they'd financed, I think it was like $18 million essentially. They had paid $18 million for improvements on their facilities, and so essentially what they had done is it came out of the liquidity, and by coming out of liquidity, it essentially came out of the line of credit on there. So again, profitable company, good company, but they were running out of liquidity because they were using liquidity for these for some of these improvements or some of these purchases on these long-term assets. And in this case, it was their it was their facilities that they were expanding and improving for them. So the best course of action for that, whether you're buying a truck, whether you're buying equipment, whether you're buying a building or improving a building, is look at doing term financing to finance that, to keep your liquidity in place, and then look at the financing and tie the financing somewhat to the cash flows of that. So that's why a lot of the times the banker, will do a 5 years for a truck or a car, because sometimes that's the useful life of a truck or a car. You might be able to get more than that, but that's kind of a safe assumption of how long you'll be able to use that vehicle. For a building, you might be able to get 10, 15, 20 years on there, because again, the building's going to last longer. But what you're doing by doing the term financing instead of paying cash is you're also getting the payments. So from that asset, hopefully there's a return by having that asset that you're getting, whether it's a vehicle that you're using in your field or you're using for delivering products. Well, because of that vehicle, hopefully there's some type of profit increase for your company well, then you can tie that profit increase that you have to that term loan payment on there. And so that payment's coming due as that asset is generating additional profit for the company. In a sense, that asset is paying for itself over time, paying its own loan, and you're not, you haven't tapped into your liquidity, and you still have the liquidity to do your day-to-day operations. So that's one of the things that I've seen in the past is customers not relying and not planning and having that term debt to finance some of these projects on there. So. And then leverage is the final thing that I'll look at in these slides. So again, as I touched on before, leverage is really looking at the measurement of how much skin in the game the owners of the business have versus how much skin in the game the banks have on there. Realizing as a bank, most banks, their profit margin is going to be 1 or 2%. On there, when we look at how much we have to pay for deposits or to borrow our funds that we're lending back out to you, that profit margin again is like 1 or 2%, depending on the bank. So there's not a whole lot of upside for the bank. So the bank's going to be reluctant to. They're going to want to minimize the risk. That's why banks tend to be risk adverse on that. Whereas as an owner, you have unlimited upside with your profits, and so. Because you have the higher upside, we would want the owner to have some skin in the game as well. Typical amount that you're going to look at is most banks are going to want owners to have at least 25 cents in the business for every 75 cents that a bank's going in to the business. So we look at how you're financing operations. 25% of it would come from equity. 75% could come from debt. That's kind of the high level. A more comfortable level is really getting to 50-50. So if you've got equity worth $500,000 or whatever, $100,000, the bank can feel comfortable putting in $100,000 on there. Like I said, on the high side, maybe if you've got $100,000, the bank might be willing to put in $300,000 worth of debt in there, but it's just ensuring that there's enough skin in the game from the members, and that also ensures that there's some balance sheet strength. It typically ensures that there's balance sheet strength for the cooperative. And again, I touched on that local leverage, which is that's unique for cooperatives, and that's looking at the net worth of the cooperative. We take out that investments in other cooperatives. So we get down to what that local net worth, that's the true, the core value of that net worth of the cooperative, and then we use that as a comparison to what their loans that they have out there. One of the things with leverage, and another reason, leverage can be good or bad on there. Leverage allows you as an owner has a multiplier effect, good or bad. So if you put in $100,000 in your cooperative, and the higher levered you are, that means that typically it's going to allow you, as your profitability as a percentage goes up, that $100,000 is going to end up having a much higher return on your investment with the higher leverage. However, if losses happen, that loss is going to have a much larger effect in that equity, and you can easily you lose your equity a lot faster than you would if you're a less levered company. One of the things that I look at is kind of being in debt up to your eyeballs. That's if you're showing high leverage, that's essentially what you are. As if you think as an individual, when you're debt up to your eyeballs, and if times are tough, it doesn't take a whole lot to where all of a sudden you can't make your loan payments, and you're bleeding through all your liquidity, and all of a sudden you have no assets because those loan payments are so high. Whereas if that leverage is lower, if you have a down year, you're not going to have to utilize as much of your liquidity to make up for your loss of your lower profits, and because of that, you're going to be in a much better position to be able to survive that one down year than you would as a higher leverage there. So. But at the end of the day, what leverage does is it really it's a measurement of how much debt to how much equity that you have on there. And again, the more amount of equity that you can have as in relationship to the debt, the more amount of skin in the game the ownership has in there, the more advantageous the bank looks at it. one of the things that we go through all this stuff. So, you know, in addition to just being approved for a loan with the bank, we always say that the bank always prices our loans to our risk. So, you know, we have different risk categories, and if you're on a higher level of risk category, even though you're, you know, the risk is low enough that we'd be willing to underwrite the loan, you're still going to end up paying a higher interest rate on that loan than you would for a borrower that has lower risk on there, that has a lot stronger balance sheet, a lot more liquidity on there. And the reason for that, it's not that the bank is trying to gouge a customer and take advantage of a customer that's having trouble finding financing. Again, the banks typically, you're looking at 1 or 2% is that net interest margin that we're getting on there. But what we have is the risk of the loan, the more capital, the more cash we have to reserve for a loan loss essentially on there. So we have to take the risk of loans, we have to have a higher percentage of cash, and we have to just put aside that we can't lend out to other banks on there or other borrowers. And so that's an opportunity loss on that. And again, the more risky, the higher amount of liquidity we have to set aside. So that's essentially a cost for the bank. In order for the bank to recoup that, in order for us to stay within that 1 to 2% net interest margin, we have to charge a higher interest rate on there. So at the end of the day, the return for the bank is going to be pretty even for, you know, a less risk customer or a higher risk customer. But the customer's going to have to pay the higher risk customer's going to have to pay a premium in interest rates to make up for the amount of money that the bank has to set in reserve because of the higher risk on there. So that's a key thing to think about, you know, as you're going forward. You know, even once you have a loan going forward, and what, you know, what this matters, what the bank's looking for when they're looking at the loan.